All righty. Good morning, good afternoon. So glad to have you with us. Thank you for joining us. I'm Dawn Lippert. I'm the CEO and founder of Elemental Impact. We're so excited to share this with you today on the D-Safe. So buckle up. We're going to go through about 2 years of work in 45 minutes. So what it's going to look like is we're going to give a quick summary of the D-Safe and the development support agreement, what they are, how they work. Then we're going to hear from Bob O'Connor from Wilson Sonsini about some of the best use cases for the D-Safe. And then we're going to hear from Nico, the CEO of Nitricity, about how we put the D-Safe to use in a real world example. And then finally, we're going to do Q&A. So we've already gotten a bunch of questions in from your registration, and we'll take some more live here on the webinar as well. And we're using the webinar format to limit the chaos, but we really want your questions, and please jump right in. All right. So where this came from, Elemental is a nonprofit investor, and after 15 years of experience investing in many of these first-of-a-kind projects and early infrastructure projects, we realized there was a really key gap that needed to be filled. We've been focused on finding and filling these gaps for many years, and this is the persistent scale gap, which is the funding and expertise chasm between technology that works and early technology and the projects that are needed to make it happen and reach commercial scale. We have quantified this in a report last year at least $150 billion. And it's not just money, but it's also expertise. So we specifically were having so much trouble finding development capital to move companies through this gap. So last year we partnered with law firm Wilson Sonsini to help address this and come up with a creative solution that we thought could lower some of the friction to getting this done and be more effective. We call that the development safe. And since 2024, we've committed about $7 million in development safes, and that's catalyzed more than $70 million of follow-on funding for projects. So the idea is to use this as a catalytic tool and super catalytic tool to then strengthen local economies, create jobs. Excited to share some of the examples today of how it's actually working. And now, after the last year and a half, we are open sourcing this tool. We've already had more than 400 downloads of the legal docs, and we're glad to see many of you, I think, on the call today, so we can walk you through how they work. And we want to hear how you use it, how you adapt it, what works for you. All right, so I'm going to bring up Amir Mehr. He's our head of project finance at Elemental to share more about how the tool works. Hello, Amir.
Hi there, John. Thank you very much. And thank you to our guests for joining here today. So just to start, we think it would be really helpful to talk through the SAFE as kind of the foundational piece on which the D-Safe was built. The SAFE was pioneered by the Y Combinator team in 2013, and in its simplest form, as the name suggests, it's a simple agreement for future equity that allows an investor to provide cash for a startup in advance of a future priced round, and in doing so, avoid the negotiating time, energy, and cost of negotiating such a deal in a priced round in exchange for what's effectively an IOU that entitles them to shares at a later date. Now, the D-Safe takes that clever idea that circumvents some of the needs of more complex early stage financings and adds to it in its simplest form two things. One, a callable option whereby the investee, in this case, the company, the startup receiving it, has the right to pay back the SAFE plus a predetermined, pre-agreed preferred return, and a term date where at that date either there's a sort of forced event, either the conversion occurs or a choice is made to repay the SAFE at that at its initial cost plus the pre-agreed preferred return. And the reason this is really sort of we think catalytic in the first instance, but hopefully something that's adopted and deployed more widely and more generally, is that it marries the best of both venture capital and that it spreads the risk rather than concentrating it in one project across the entire company and its portfolio, if you want to think of it that way, of projects, but also introduces the disciplines you see in later stage financing, such as project finance, by having milestone payments and associated mechanics, pre-agreed situations in which the funding occurs that ultimately provides flexibility to the company without prejudicing its ability to raise capital at a future date, but also gives the investor either the upside of investing in the company and its long-term growth or the ability to get an acceptable rate of return while unlocking these critical catalytic projects in the first instance. Without boiling the ocean and sharing every little bit of detail of what distinguishes the D safe from the standard safe and 3 and 4 below, you could think of those as being very similar to how a standard safe works. The two biggest features, as I mentioned previously, are the repayment and the term date. And at least up until now, the repayment has been structured whereby the option and the right is such that the company can pay back the investment amount plus a preferred return of anywhere from 8 to 15+% in our experience to date. And secondarily, as I mentioned, the term date, when the term date is reached, the DSAFE either converts or the company makes a final election to repay it. Ultimately, we think this is really efficient and important. And while there are no shortcuts, you still have to diligence the company, you still have to diligence the project, you have to agree on other milestones. What it does is it allows you to more quickly, more cheaply, and in a much more collaborative fashion come to terms on a transaction that, especially for those deals and that are in the no man's land that maybe are too small for institutional investors and project finance or other providers, but also too large for venture capital providers to play and help unlock these critical catalytic projects. And finally, just to sort of bring it all together, how is that realized in practice? As I mentioned, the D-Safe itself, the safes might be dispersed in a variety of different milestones that are determined based on the sort of commercial needs of the underlying project or opportunity. And the way we achieve that in practice is by having an umbrella agreement that serves as the architecture for the broader transaction and deal called the Development Support Agreement. And that not only memorializes the investor rights and covenants between the parties and the development milestones, the payments and the terms and repayment mechanics to some extent, but especially in Elemental's case, it also covers the specific things we do in terms of providing technical support, helping the company identify and unlock partners for, say, critical contracts such as offtake agreements, and or stakeholder engagement to unlock tricky and thorny issues around everything from regulatory challenges to permitting hurdles. With that, I think I'm pleased to introduce my colleague Avra van der Zee, our COO, and Wilsonson Senior's own Bob O'Connor to dig in a little bit.
Thank you, Amir. It has been such a pleasure working with Bob and his team on this. With Bob's 30+ years making climate technology projects happen, I can't think of anyone better positioned to provide the broader context of why this instrument helps fill a market gap. So let's dive in, Bob. You've probably seen more investment structures than anyone out there. Talk to us about this problem and how the Development Safe and the Compendium DSA seek to solve it together.
Thank you, Amir. It's just been a pleasure to be here. And I'll tell you, it's been a team effort with you all. You've been incredibly innovative and creative in providing a solution to the market. But the solution that the way I look at it is the D-Safe is part of a solution for this now age-old challenge of bankability of first of a kind or early of a kind projects. As I think we all know by now, like nth of a kind traditional projects are financed on the back of proven technology and creditworthy offtake, which supports project debt, the availability of which is simply dependent on predictable long-term cash flows. With folk or early of a kind projects, those conditions are simply not met, and therefore traditional sources of project level capital are not available. So what is the market to do? The market's answer, by and large, for early stage projects has been equity, where venture dollars fund corporate balance sheets that ultimately represent highly dilutive mechanisms to effectively equity finance these projects. This is not to say the market has not endeavored to be creative. It has. We've seen a proliferation of what we think of as hybrid equity structures, of which I think the D-Safe can be a very important new entrant. These hybrid structures invariably involve elements of debt-like protections with equity-like risk-adjusted returns. We've seen this with project debt, with warrants or other equity-linked rights. But at the end of the day, these structures we tend to see in like later stage commercial scale up involve larger check sizes from, the PE crowd or the growth stage or infra, crowd, and is not really well suited for what we in Elemental designed the D-Safe to be most effective for.
Thanks, Bob. I think that's great. I think it'd be great to hear a little bit from your perspective into why we think it's effective. So we talked about how, it's structured. We heard from Amir about some of the important mechanics around conversion. From your perspective, what makes it innovative and really what makes it effective and a useful instrument?
Well, as I think we saw from Amir, and I believe the elegance of the D-Safe is in its flexibility. I mean, at its core, the D-Safe gives companies the ability to fund early folk project development at a significantly lower cost of capital than the alternative, which is effectively venture dollars. And depending on where those economics are ultimately set, companies are afforded the ability to repay the D-Safe at a reasonable cost of capital that is lower than venture. But at the same time, for investors that are drawn to this, it affords them with a framework where the company can either optionally, repay the safe, or that the investor can optionally convert and achieve the equity-like upside that is befitting the risk that the investor is being asked to take. So together with the DSA, I think it also affords protections given the milestone-based nature of the conditions upon which the D-Safes are deployed. And I think there's some menu options that include other valuable rights, not the least of which are, pro rata rights to invest in future corporate equity, or ways to gain access to future, project level capital deployment. So again, while I think the YC Safe, as Amir pointed out, was an acronym for Simple Agreement for Future Equity, I think of the D-Safe as a simple agreement for flexible development equity.
Yeah, I mean, I think from our perspective, we see those milestones particularly playing a role as we're investors trying to help provide project support and really hone in on development capital and where there might be project and development support needed. But as with any tool, the value of the D-Safe depends on it being used for the right purpose. So I would love to hear from you about what you think are the best uses for the D-Safe, and then relatedly, where it's not best suited and maybe what the limitations are.
Right. Yeah, absolutely. I mean, I do think we need to keep it real. I mean, I think that the D-Safe is really well suited for smaller dollar early stage financings that really are intended to be catalytic. So early development work of a pilot or an early commercial project, or providing just working capital necessary to hit, commercial inflection points. The tool, I mean, the beauty of it also is in its familiarity and its simplicity. But on the other hand, it's by design light on covenants, light on governance, and relatively light on, traditional debt-like structural protections that you would see in a more significant financing. So we think that as a result, I think so that's kind of where we see the wheelhouse for the D-Safe being, and is not meant to be all things to all opportunities.
Exactly right. And I think, you'll see in our practitioners' notes various different options for how it can be customized. But I think that framework of where it shines and where its best use is and where its limitations are is a really helpful sort of framework to keep in mind as thinking about customizing it to a particular project and or investment. So with that, I'll say I really can't wait for what we build
Mhm.
together next, Bob. Thank you for joining us today. And I'll bring on
My pleasure.
Dania to talk more about a specific use case. Dania is our VP of Portfolio and Investments. Over to you.
Thanks, Avra. Nitricity is a great example of one of those use cases. So I wanted to bring on Nico Pinkowski, the CEO and co-founder of Nitricity, to share his experience. Welcome, Nico. For some quick context for folks, we first invested in Nitricity in 2022 to help build out their demonstration facility in Fremont, California, and then we doubled down in early 2025 with the development safe to fund the next facility, which was a 100x jump in scale and production. That one is in Delhi, California. So Nico, can you tell us a little bit first about Nitricity and then the first of a kind commercial facility in Delhi?
Sure thing. Thanks, folks. Nitricity manufactures nitrogen fertilizer using air, water, renewable power, and recycled agricultural biomass. Our objective is to reduce some of the emissions associated with nitrogen fertilizer, which make up anywhere from 5 to 7% of total global greenhouse gas emissions. And other objectives that we have include supporting healthy soils and improving farmer yields. Mid last year, we developed a new fertilizer product, and we signed many long-term offtake agreements in California for this product. And we found us a great site located in the heart of California farmland in order to build a new facility. And it is in Delhi, California. This is an image from our groundbreaking ceremony where we had Elemental and many others attend. It was several weeks ago. Altogether, it's about a $12 million project. It's creating 25 construction jobs, 10 full-time jobs after construction. The business model is we build and own a fertilizer factory where we buy renewable power, sell fertilizer, and multi-year offtakes. We're working hand in hand with the local community leaders, and of course, we built a variegated capital stack in order to make this happen, working with Elemental and the innovative DSafe as the nucleus of that capital stack. It included a government grant, a tax credit, philanthropic capital with the DSafe and other philanthropic capital, and then investment from a corporate strategic investor.
Fantastic. And let's talk a little bit more about that capital stack. We committed $2 million to help you close the project funding gap. We had talked about going in safe or convertible note, but landed on the development safe. So can you share a little more on why that was something you were excited about and what we were able to accomplish?
Absolutely. So at this time, it was some time after our Series A. We raised our Series A in summer of 2022, and we just demonstrated a great product market fit with the new product. And we were faced with a choice. We knew we wanted to build a large project. Should we raise a Series B, like a Series B that was smaller than we might have wanted? Or do we want to go out and raise dedicated project or finance for this project, delay our Series B and go out and raise a bigger Series B, kind of built off the success of a fully financed and mid-construction project? And the DSafe in particular was a really interesting potential opportunity because we saw with Elemental before that Elemental funding and we thought this DSafe funding could be a nucleus to put the whole 10 million in finance together. And there was kind of two reasons for why I personally was intrigued about this as a CEO. One is because safe notes are a well-known entity, and so the safe note side of the DSafe, I can get it through the board. Everyone likes safe notes; they're easy to understand, and it's like in one form, we can always take this as a safe note, and so it's good for operators to explain to folks. On the other side, I knew that if we were to do like project level finance or debt financing, it would greatly help our company mature because I know that this is the future of our business is building and building at the project level, and that could be really something special to showcase in our Series B, and so we wanted both. And one thing that could come to mind is that you could do a convertible note. But yeah, as I think will come up in the Q&A section, there's just a lot of benefits over this DSafe over a convertible note. And many times convertible notes to get a very high level of scrutiny by like venture companies like Nitricity's and boards, and can take a long time to get done, and wouldn't necessarily be that nucleus that we were looking for.
Yeah, thanks for breaking that down. You're well on your way, having raised that Series B just recently, the $50 million B led by World Fund. So congratulations on that. And once you're able to prove out the scale at this 100x capacity in Delhi, you'll be poised and ready to replicate these facilities across the country, across Europe. So we're excited to be on that journey with you. You ended up electing to repay the DSAFE this summer, actually just 6 months after the initial investment. I wonder if you could share why you decided to go that route.
Yes, for not just for once, but it's rare that plans come to fruition, like perfectly as everyone hopes they do. But in this instance, everything came together really well. We delayed raising our Series B. We did dedicated project finance with using the DSAFE as a nucleus to put together the capital stack for our folk, and then we raised a Series B starting in Q1 this year. And we showcased the success of financing our first of a kind factory, getting a firm offtake. We showed pictures of the initial construction and hearings and permitting successes, and we were able to raise a great financing round in a pretty tough market because we were showing so much progress, and our focus, not just because of the folk, but largely because of this focus coming together so nicely. And upon closing the Series B, many founders and investors, I'm sure, spend countless hours looking at their cap table and the pro forma, trying to make sure the round and everything fits together. And for us, one night after staring at this cap table, trying to figure out how everything would fit together on the finish line of the deal, we realized the flexibility in this DSAFE was a tremendous asset. And I remember I called you, Dania, and others on the team, and Dania and Jackson. I said we started talking through how about whether Nitricity could repay this and what that would look like. And what that would do is it would create space on the cap table. And for our case, it was to make sure we had a sufficiently sized employee stock option pool, which is important to me because there's otherwise potentially a little tight, and I wanted to make sure we could recruit, retain world-class talent at Nitricity. And so we did just that, and everyone was very impressed and excited that it came together like that.
Yeah, and we were happy to be able to then support you all, but also recycle those dollars to support future entrepreneurs. Okay, well, with that, I'd like to pass it back to you, Don. We've got lots of great questions coming through in the chat and quite a few from the registration. So we'll jump into this.
Okay, sounds good. I think we'll bring the whole band up here so we can rock through some of these questions. But Amir, I think we'll start with you. One of the questions that came in the registration is like, what are some of the key variations we should consider for this? So I think we have a little chart to help answer that one.
Thank you. And happy to take a stab at this without being exhaustive. I think there are a couple of things you can consider. The first variation I would sort of always encourage people to look at is marry the DSAFE to the specifics of the underlying opportunity. And that can be everything from matching the obviously milestone funding mechanics to the actual commercial needs of the project, to also designing the repayment, the exit, for example, the maturity date, or even the cost of capital associated with that. There's nothing that stops you from having ratchets in either direction to change that preferred return to either incentivize or disincentivize certain activities. But either way, match those to the specifics, so adapted to the project needs. Time horizon by that same token can be something that you can play around with in terms of aligning incentives and outcomes. And then, depending on the sort of objectives of both sides, you might look at variations. Although this adds time, cost, and complexity, which is what the DSAFE's designed not to do, but things such as aligning outcomes by, say, introducing warrant coverage for those who want, perhaps to incentivize repayment, but also if the company does really well, participate in the upside. In any case, I think there are, depending on the specifics, many ways you can take it. And what I would encourage folks to do is look at our practitioner notes, where we've somewhat exhaustively listed a couple of the options we've actually tried out in the real world ourselves and or have thought about, but maybe haven't had a chance to put into practice.
Yeah, that sounds great, Amir. And there's a couple questions coming in here about sort of how Elemental's using this in our program. So I'll just clarify that Elemental, we use a number of different investment tools. The D-Safe is one of them when it really makes sense for a company. We also use regular safes and a handful of other investment tools as well. So at Elemental, we think of ourselves as quite flexible financiers to try to be as catalytic as possible for what it is the company needs. So we could use that for project stage companies, for strategy track companies, and really depending on what companies need. Let's see, Bob, there are some additional questions here about how the D-Safe is different from a convertible note or different from debt, and then also how it shows up on the startup's balance. I was wondering if you could address some of those.
Really good question. First, you'll also find in the practitioner note that the details matter in terms of whether this is ultimately to be accounted for as equity or debt, depending on the terms and the circumstances of the call option. In terms of how it's different, I mean, first of all, on liquidity, it's pari passu with your senior preferred stock. It also doesn't, unlike venture debt, it doesn't have a current cash pay interest. It doesn't amortize after a period of time towards maturity. It doesn't have a covenant package, negative or affirmative. And it doesn't have events of default that would accelerate repayment. So in that sense, it's very safe-like, it's very equity-like. But the call feature may ultimately want it to be accounted for as debt on your balance sheet or debt-like or as a mezzanine security. And I think that's a really good conversation. We did reach out to a Big Four accounting firm and asked how we would want to treat this as whether it's equity or debt. And I think with the call feature, I think it was leaning debt, but it is ultimately facts and circumstances and will depend on the terms of the call. So consult your accounting advisors.
That's great. Thank you. That's really helpful. Let's see. There's a question here about the types of participants that are interested in investing in D-Safes. And I will just say that what we've seen is that there is some interest from traditional lenders. And maybe Amir and Abra can walk through some of what you've seen here. I do think that for folks that are particularly family offices, foundations, early infrastructure funders, of which there are actually a few dozen around that are trying to address sort of the missing middle, that seems to be sort of the key folks that would make a lot of sense to deploy a D-Safe. It's unlikely to be sort of like banks and infrastructure investors, and it's unlikely to be sort of straight VCs who really want to drive ownership of on the cap table. So that's really what we've seen. It's folks that are really focused on bridging this gap and want to share risk in sort of a different and creative way. But Avery, anything you want to add there?
No, I think that nails it. I would just add that actually by having that catalytic layer come in and play a role, you do see some more traditional investors coming in to help with that first of a kind or early of a kind facility to get to that next proof point. So they might not be interested or using the D-Safe as we utilized it, but our D-Safe tranche then brings in additional potentially more kind of traditional capital. So we've seen that unlock happen in a number of cases. Amir, over to you to add something. It seems like your hand's up.
Yeah, sorry, I'm really eager to share it. But just fully agree with Dawn and Ava here. My hope is in the long run that the D-Safe actually does, though, become something that commercial lenders and investors might consider using as a part of a broader strategy, because you could envision it as being a really catalytic tool that allows you to sort of use the D-Safe as the entry point to gain access to the investment at a later date, depending on the obviously priorities and specifics of what the fund's trying to achieve. But you can imagine a scenario in which you fund the D-Safe with a very small portion of your fund, and like a venture capital firm does, spread the risk across a variety of projects. And all you need is a handful to really be successful to then translate into meaningful projects that you can double down on 10-fold, 15, 20-fold.
Thanks, Amir. Yeah, that's a great point. And we really are thinking a lot about sort of the portfolio of projects and how this sort of goes over time. Let's see. There's a couple questions here about milestones and how we define milestones. And not every investor, I think, will use milestones the way we do. Elemental has been milestone-based funding really since the beginning. And we see this as a way to align ourselves and our plans with the company to provide, we provide a lot of services along with the financing. And so it's a way to align the services that we're going to provide. But we do have a slide here on milestones. So I think it would be helpful to walk through this, Amir. And then Nico, if you wanted to talk about any of the milestones and how it worked on the company side after Amir, that'd be great too.
Happy to, and I apologize to the folks who aren't in the world of energy because unfortunately this has an energy bias, although it overlaps often with many other types of infrastructure projects. But on the commercial side, oftentimes we're just marrying the milestones to the specific commercial objectives that need to be achieved to get the project, quote unquote, shovel ready for a final investment decision. And that might be, activities associated with securing the site. It doesn't really make sense to start engineering design if you don't have a site in place, right? Then the engineering work, permits and approvals, offtake agreements, and other commercial contracts. And then finally, the next natural step would be to actually secure the broader permanent and construction financing to get things off the ground. On top of that, oftentimes we think there are, other critical milestones that need to be achieved or that will help de-risk the project, such as, specific technical assistance that we might as Elemental lean in to provide, or the stakeholder engagement to, say, accelerate the permit and approval process by having an on-the-ground presence. But once again, the specifics really matter here, and this is just a flavor of the sort of milestones we often put into our agreements. But with that, I'll let Nico add whatever he thinks I've missed and more.
These 6 examples on the slide in front of you are somewhat similar to the milestones implemented in our Nitricity and Elemental DSafe, but the order was very different, and not all were included. And so I think for us, for example, we had the offtake agreement signed well ahead of time, and so that one was not included. And so I think that these are great examples, and it certainly shouldn't be limited to these, and the order should be dependent on what each individual company needs.
Yeah, that's great. And then Daniel, maybe just this last question just came in on how milestones are decided upon in the Elemental process and sort of at what point in the process.
Yeah, absolutely. So one, it's a co-design of the project. So companies will apply to the program, fill out the intake form, and then we will work through the diligence process. And then once accepted, we'll ultimately scope out a project together, outline what those key pieces are, and then milestone safes or DSafes will be issued based on those. So it's a co-development. It doesn't need to be upfront. Encourage you just to apply and share what you have in mind, and then we can scope the right project. Typically, our projects are around 18 months, so it might not be the full scope of the entire project, but something really targeted we can do together.
Great, sounds good. So Bob, I wanted to come back to you on sort of how the DSafe lines up in the sort of capital stack and in seniority against other investors. I mean, Elemental, we've done this different ways. Like we've taken the senior position, we've taken more of a junior position. But I'm just curious if you could talk through how you have sort of seen or what you ideally think the DSafe would do in terms of lining up there.
Yeah, no, it's a great question. As you know, the traditional safe is pure equity. And I think the thing to keep in mind is as you implement a DSafe, and to the extent you've raised like a seed round or an A round, you should run the traps to understand how your existing preferred stock or even how like an existing venture debt facility might interrelate with the DSafe. At the end of the day, when you sign up to a security that gives you the ability or even the ability of the investor to call the security and be repaid, that will be the sort of security that preferred stock investors will have a point of view on. And frankly, your senior secured venture lender will have a point of view on. So you'll need to kind of ultimately, work the process as you would any other security. But here it really is hybrid. I mean, I think at the end of the day, it's very equity-like in its simplicity and its elegance and its, covenant package and governance light nature. Um, but it's contractual. So it's debt-like. So I think it's going to sit like above equity, but it sits below debt. And I think that's where it's going to land. And I think, contractually, it borrows and leans on the YC language. And in the YC language, upon liquidity, you're pari passu with the senior most preferred. So you're not sitting above them contractually. I mean, I think that's something that can be one of these adaptations that you work with if you want to sit above the preferred, but leaning and standing on the shoulders of the YC safe, it sits from a seniority perspective alongside the preferred. So in short, we think where it ultimately lands depends on the terms of the call feature, how conditional it is, how within the control of the company it is. And I think it's going to be where it sits on your balance sheet for CFOs that care deeply about these will be ultimately depend on the facts and circumstances.
That's exactly right, Bob. And I think it also, I mean, a lot of it depends really on what your board is comfortable with and what you can get through, right? And that's where sort of the negotiation always sits as it relates to equity investors, bringing on debt investors and project investors. And there's always sort of this tension because there are some different sort of priorities across those investors.
But primarily it sits within the control of the company, whether to ultimately um, repay the safe unless certain other milestones are met, but those milestones, can be designed to ensure that, as with, say, Nico's scenario, it really was a benefit to the company to be able to make the judgment to repay the safe, open up some room in the cap table, in this case, for Nico's team. So
Yeah. And a huge win for us because as Elemental is a nonprofit, right? And so we're a catalytic funder. So if we can have dollars back in 6 or 7 months, we can just bring them into the next project to do the same thing and provide the nucleus of project funding for the next project. So that really is, I think, how we, I've been talking about it as like sourdough starter, but that's really how you like keep, baking more and more bread faster, right? Is get those dollars repaid faster. So it was really a win-win. There's this other question here, I think that's really relevant to this, which is, are there protections for funders if the startup raises significant equity later at a high valuation, but the specific project tied to the D-Safe fails? And I think this is like the core of the D-Safe. So Bob, do you want to just address that real quick?
yeah, no, this is corporate equity and corporate debt. So if you ultimately choose not to be repaid at your preferred return, you are participating in the upside of the corporate equity and you're participating in the full portfolio of assets and value creation at the corporate level. So even though your milestones might be your use of proceeds of your DSAFE might be tied to a specific project, your upside is based on the entirety of the enterprise.
Right. And this is one of the key things around sort of the missing middle, right? Is that that's been the real challenge is getting project funding when there's companies that have a lot of like sort of
Yeah, and that's a nice structural de-risking.
yeah, for sure. So Nico, there's a question here that I think would be helpful for you to weigh in on, which is around like sort of prefs and discounts. Have they closed across your deal? And then Danny, maybe we can talk about some of the other deals because we've done 9 D-Safe investments so far across a number of different sectors, different sizes ranging from a few 100,000 to a couple million. So we've seen a few different things here in terms of how it's been catalytic. But Nico, maybe just to talk about specifically how some of the less concessionary capital has like come in and been catalyzed by the D-Safe.
Yes. So we started working on the DSAFE first. I mean, we had the government grants in progress for a while and tax credits in progress for a while, but we raised the rest of the capital stack was a DSAFE, another philanthropic investor, in this case Trellis, and then a corporate strategic investor who wished not to be named. And for those three parties, and others interested in the round, this DSAFE was really kind of at the heart of the that side of the financing. And so I won't share the exact terms of our working agreement with Elemental, but really what I can share is that we anchored on those terms for the rest of the financing, so that everyone, you know, we had another person invest on a safe note with a side letter that tied some things to the milestones of the project, or earmarked some of that funding to be used for the project. And that safe note and side letter were on very similar terms, and kind of set by the working agreement of the DSA and DSAFE with Elemental, and similar to the press.
All right, we got the next generation super excited about the DSafe too, Nico. It's great. But I do also want to ask you, just like in terms of, we have like 2 minutes left. There's many more questions. We will continue to sort of answer these, and these are, we'll send out some more information in different ways as well. But Nico, I was wondering if you just for a minute just share sort of how you think this provides the template for the next project financings, because that was a huge focus of the work with Amir and Jackson and our team, right? Of really figuring out how to make sure this is underwritable for the next project.
It's a good question. At a very basic level, this was the first example of Nitricity, creating a subsidiary that's wholly owned and controlled by Nitricity at the top co level, and doing financings. As Bob said, the DSAFE and the DSA are at the corporate level, but the DSA requires the existence and structuring of a project level entity. And then going through that exercise for companies like Nitricity that are scaling hard tech new climate solutions is extremely valuable, because that has to happen for all of the other projects, and it forces you to do that, which is not the case for a simple safe, for example. And so that I see as one of the key strategic benefits of this.
That's exactly right. So our team essentially used like sort of project finance underwriting criteria, and like worked with Nico's finance team and to really build out what that would look like. Okay, final one that I'll have Ava just weigh in on, maybe for a few seconds here, is how you're sort of thinking about how we're thinking about the DSafe aligning in repayment. So we've taken a couple different tacks to this, but I think it would be helpful to share here, because there are probably investors listening who would want to be more senior, would want to be more junior.
Well, like the sort of motto of today is the details matter and the devil's in the details. I think you want to make sure we're aligning the risk up front and thinking through the repayment. And in the practitioner's note, where we talk through variations and options, we added ways to make sure that the negotiations are happening up front to talk about what might happen on the back end in terms of alignment on repayment. And that was one of our great learnings across implementing the DSafe over 9 specific projects, is the more you can do upfront to talk about what other repayment expectations there are from other investors and sort of the board overall, the better and more seamless the process will be. And so we do really see that they're, like as Don said, as a nonprofit, we love the ability to be repaid within 6 months and recycle forward, but that's upon achieving milestones and the company and the project's doing well. So we're not looking for that repayment if there's no liquidity to make that repayment. And so I think it's important to just, if there's more, curiosity here, take a look at the practitioner note in terms of variations, but also think about the more you can do up front to have that negotiation. So all investors, different flavors of capital, are coming in with an awareness of what might be in this instrument. Anything to add on that, Bob?
No, I think that's exactly well said.
Great.
Okay, on that note, it is 16 minutes after. We are so grateful to you for spending some time with us. There was a question here about folks that have used this and examples. We want to hear those. I mean, we released this less than a month ago. We've already had a lot of interest and inbound on it, and we're very curious how folks are using it, if it's useful, if there's things that we should amend or update, and we're going to keep, sort of sharing our learnings as we use this also. Our whole goal is to use this on our side to build the field more broadly because we see this as a giant bottleneck for companies, and we want to find ways that entrepreneurs and investors can align on solving it. So that's our goal. We have lots of detail in the legal docs, in the practitioner's note that really walks through some of the examples, and we want to co-create with you and hear from you. So thank you all for joining us, and have a great day. Take care.